Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
That's right. It feels like official summertime now, mid-June, as we're kind of kicking through things. And both myself, my co-host here, both financial advisors, certified financial planner, chartered financial consultant. And for years I said we spend our weekdays meeting with people like yourself, but
we don't know you. I don't know whether the people I meet with during the week are like you or not.
Yeah, and it's not as many weekdays as it once was.
We are nearing the twilight of our career.
Well, I don't know about the twilight.
For me,
that's what the organization says about me anyway. Right? I don't feel it anyway.
With my private parking, every time I come to work, it's further and further away from the building.
Private parking. I'm going to start with a real story. Then we're going to talk about the markets. We got some calls. This was, this must have been 25 years ago. And we were back in Omaha, Nebraska to visit with somebody. Anyway, there was somebody back that we were visiting. And while we were there, we had some business. I think it was Mutual of Omaha. It was one of their subsidiaries, I believe it was.
That's correct.
And so we thought, why don't we go have a stop over there and meet some of the people in charge of the product. This was a long time ago. The industry's changed quite a bit. And so it's like in the middle of winter in Omaha. It's windy. And we go looking for parking, and there's like 8 parking places right up front by the front door. And it says, executives only. And Pat says, oh, no, that's fine. We'll go ahead and park here. I'm sure the executives would be happy that there's some customers here. And so I'm like, what? Oh, yeah, just go ahead and pull right in. So, okay, so I pull and I park. We get out, and the security guard comes, starts running over. You can't park here. And Pat says, no, it's okay. It's okay. We're customers. We're customers. It's okay.
Did we stay parked?
No, it didn't stay. It didn't work.
Well, it kind of shows you my attitude about how important the customers, clients are to the business.
Oh, yeah. As Pat has always said, too. It's like the employee of the month. Go ahead and park there. And any employee of the month would want a customer to park in the front.
Wouldn't they? Anyway.
I don't know. I started off on that tangent.
But, yeah, it started as tangent. Well, Scott, I got to tell you, I don't think we were the only ones that said it, that when this bromance between our president and Mr. Elon Musk blows up, it will be a monumental. We talked about it when it first started here on the program, and many, I heard it on many, but this has been spectacular.
Well,
this has just been spectacular. It's hard to...
It's funny. I think regardless of where, unless you are on the extreme fringes of the left or the right, there's a lot of entertainment value in the political environment right now.
It is so juvenile.
The last 6 months, it's been a really fascinating time. And my wife says, it seems like you're more interested in politics. I was like, it's just interesting. I mean, there's so much going on.
Oh, it's so juvenile. It's just so, you just shake your head and you think, wait. What?
It's kind of blowing over, though, it seems like.
Yeah,
finally. The news cycle moved on.
But then at every couple of days it pops up. Anyway, all right. But
I was thinking, the financial markets higher than, what was it, Liberation Day. They're back higher than they were at Liberation Day when the markets tanked. And I was thinking.
Liberation Day.
There's been like so many news stories that are like once in a year in the last 30 days, it feels like. Anyway, Liberation Day, whatever that was supposed to mean. But there was a lot of fear and panic. The markets essentially went to a bear market. We were intraday 20% down on the S&P 500.
Like the beginning of COVID.
Yes, and now it's recovered so quickly.
That's right.
And I was thinking about this. Markets have always recovered, and they always will. But typically, the average bear market's about 9 months of declines.
Of going down.
down, down, up, down, down, up, down, up, down, down.
And before
up,
it finds before it hits a bottom.
9 months.
And we're using the definition of a bear market.
20%.
But that's
fall.
not technically the definition, but we're going to use that.
It's a made up definition. It's not like
all right. Okay, it's
mathematics or science.
Okay. Fair enough.
But it was so short, and I was thinking, like at the start, we're like, don't panic. Like this will too pass. We'll hit no highs again. And I don't like being not proven right, but I guess kind of proven right so quickly because there will be a bear market.
That's long.
And if you went through this and it caused a lot of stress and anxiety, maybe you have more in stocks than you should or need.
Yes.
And if your lifestyle is not dependent upon you having 70 or 80% of your portfolio in equities, and you had a lot of fear and anxiety the last couple months, maybe this is a good opportunity for you to pare back a bit and diversify away from stocks a bit.
And rebalance your portfolio.
And rebalance that portfolio because...
And by the way, you should be
we'll have another downturn.
People, I think one of the biggest mistakes people make in their portfolio, especially in IRAs and 401ks, is that they don't rebalance them on a regular basis. They don't have an investment thesis. And the other is...
That's because when things are going up, why would I want to get rid of this fund? It's doing so well.
Well,
this
I
stock
understand why it's doing, but it's still a mistake. It's still a mistake, even though we know why they do it. Right? Pensions don't do it. Pension plans don't let their portfolios run forever. We don't let our clients' portfolios run forever.
Of course not.
Yeah.
Because we have an investment thesis going into things.
Correct. And the other is tax, not paying enough attention to tax.
But look, there will be another, like if you look at the last 25 years, two major bear markets, right? The financial crisis.
Oh, yes.
Which was mid-2007 to February or March of 2009. So it was a long one of new lows. Then, of course, it recovered. Before that was in 2000 to 2002. It was 28 months, 29 months.
And that's when was the bonds? What year was that? Where the bonds just did terrible.
94?
Yeah, it's 94.
Now you're dating yourself. Anyway, but the time to reduce any sort of asset class, you don't want to sell when it's down. You want to sell when things are up, right? That's kind of like they talk about the first day of finance class.
But it's hard to do.
Buy low, sell high. Things are high, expensive. Now is the right time to looking at rebalancing and having the appropriate portfolio for yourself if you didn't have it already.
And especially, as you said earlier, if you were nervous through this whole thing and were like, it probably is a good check that you are overweighted equities.
If you've got enough assets to maintain your lifestyle without that risk. If you find yourself in a situation where you're not going to be able to make your cash flow needs the next 20 years without having equities, then you got to either figure out
how to live on less,
either live on less or live with the volatility. Those are your options.
Yes, and get used to inflation.
So another story in the last couple weeks is UnitedHealthcare. That stock.
Okay.
Cut in half this year.
Yes.
It had been a darling of, essentially a big roll up in the healthcare space, right?
Yes.
Buying all these hospitals and all these different healthcare providers, and most of the revenue coming from government controls medicine. Let's face it.
Yes, and their diagnosis is, there's scandal all the way around that company now.
Alleged scandal.
Okay.
It certainly appears that. So the stock essentially has been cut in half. CEO is out. And I saw some article from the employees and how their stock's down, their 401k is down. And as I'm reading this, I thought, there are people whose lives their lives have been changed as a result of the decline in that stock this year. Their financial futures have been changed. Their retirement plans have been put on hold. Their kids' educations have been changed because they were overweighted in that one particular stock.
Okay.
And the only reason they were, by and large, was because they worked there.
That was them.
But we see it. There's other people who
Scott,
work
I got to tell you, this might sound heartless, which when someone says that, get ready, it will be 100% heartless. Every time I read an article about, what happened to these poor people because their company that they went, look, it was, they have control over most of that.
You mean it's kind of like when somebody gets stuck in the mountains in a snowstorm without any food and water, and they were shocked that this happened.
Yeah, and
you're going in the mountains. There's a storm warning that says to stay home.
Yeah, and even look, you and I own a small company. We brought liquidity to our own financial situation by bringing in a third-party investor. That was, and people say, well, because you were really just wanting to try to grow the company. No. That would have been nice, and it happened, but the main objective was to diversify away.
But the issue, Pat, we see every day, our advisors see it every day, someone works for an employer whose stock has done well, and the majority of their worth is tied up in that individual company.
And
so when I
see
stuff like one of the, I don't know what number, UnitedHealthcare is one of the top 10 or 20 companies in the U.S. I don't know.
It was.
Yeah, I mean, but it's a massive company, and you see something like that get, so quickly.
It happens fast. Well, let's. What was the oil company in? I mean, we could go through a list of these.
Yeah, a list of them. Speaking of the oil company, we're in California. A little side note. I was in Hawaii last week on vacation with my family. It was great. All 4 kids were there. My oldest is 29. My son's 27. They were there. My son's girlfriend, my younger girls. We were all together. And we survived the week.
No fighting?
Well, there's a little. Their siblings and stuff.
Well,
and parents get frustrated. Of course, there was some argument. It's part of life. But gas in Hawaii was less expensive than gas in California.
No.
I swear to you. I look at this like, how is it that
that's amazing?
An island that has to import all of their gasoline is less expensive than California, which used to be a big oil producer.
That's amazing.
And 2 more refineries are leaving.
Yes.
I just was baffled by it. But the reason I brought that up, the 2 reasons. I was in...
To show off that you were in Hawaii.
Of course.
Number one.
I figured you were going to ask about the tan. I kept waiting for her. Man, Scott, how did you get so tan? You look so tan and rested, but it never came. It's interesting when I take Uber. I used to be cabs. Now it's essentially Uber drivers. And I always enjoy talk when I'm out of town, kind of just getting their perspective on their life and what's going on. And so this Uber driver, and I like.
So now, would you get into whammo and actually without a driver and ask to speak to an AI agent?
I'm afraid to get torched.
Well, that was kind of a different story.
So I'm talking to this Uber driver. He'd lived in Hawaii his whole life. He's probably 50 years old or so, and this kind of beat up Uber he was driving me around in. And he was telling me, he says, I can tell that tourism is down from because of the turmoil in the markets. And we're talking about it. And he says, my experience has been it's the high-end hotels do fine regardless. Okay. He says, like, if you go to the high-end hotels right now, they're probably completely booked up. They're crowded because those people, the fluctuation in the markets don't have as big of an impact. But he says when you take kind of the lower-priced condos, those are the ones that take the biggest hit. And he says he's really noticed a difference in the number of people in some of these lower-priced condos just because...
That's their indicator. That's his indicator. His market
That's
indicator.
his indicator.
Market indicator.
So we're
makes
changing
sense.
our investment thesis based upon this.
Uber drivers. So where are you going with this?
It got me thinking. I was in Hawaii probably 20 years ago, And I read a book at that time. I forget the title of the book, but it was essentially about how the top 10% continue to get wealthier while the middle has stagnant or decline.
Yes.
I read this 20 years ago.
And it's true today.
It's maybe more so today.
And AI is going to propel this.
It already has. I mean, look at the billionaires minted over.
Understand, Scott, but here's, so I was looking at finish your story.
I think I finished my story.
Okay. I was looking at the price to earnings on the S&P 500.
It's like 21.
It's relatively high on a historical basis.
Yes.
And I was thinking, what's justifying this price to earnings? Because there's something that the investor is saying, I'm okay with this price to earnings. That's what the investor says. For the risk here, the alternatives are not better elsewhere. That's how the markets work. And I was having a conversation with my brother who was the CEO of a technology company, but he's still pretty involved with them. And he said the AI leaps and bounds that they are doing with their technology. And I look at our own company, and then I talk to other people that are running companies, and I think this is, as a societal issue, this AI is very disturbing. It is going to displace many, many middle-income workers and even management. But it's going to be great for the stock market.
Okay. And it's going to be great for a lot of individuals, just not all.
That's right. That's right. It will create a major displacement.
And I'm not one of those that believe we're going to see 20% unemployment. There might be some short-term disruptions.
That's right.
Every new technology, it's always had some disruption, but there's always been new jobs created. I think we'll probably see the same thing. We might go through a bit of a hiccup along the way. But I totally agree with you.
But I think that the price to earnings ratio is being supported by
I totally agree with
the economics that are coming.
I totally agree with you. I'm a late adopter when it comes to technology personally.
Yeah.
Not as but personally, I'm always a late adopter. I never had a BlackBerry. I just kind of waited. I didn't.
Really?
Yeah, and so I'm a bit of a late adopter. But I look at, I just look at some of the applications, even that we're using here internally at Allworth, and you can look down the road and say how much more efficient. We have 500 employees or 600 somewhere in there. How much more efficient we can become, how much growth we can have without adding any back office people.
That's right.
And even our advisors, how much more, you think about technology today and how much more effective and efficient an advisor is today versus even 5 years ago. And then you look 5 years out, I'm just looking at our own little industry.
And that's why actually I think that this normally at a price to earnings ratio this high, I would be a little bit nervous. I would say
I'm always a little bit nervous.
All right, well that's fair. That's fair.
I'm always a little bit nervous.
That's fair.
I can't say I love it. Look, I don't like this volatility in the markets any more than the next person.
Well,
does.
but that's the risk premium. So
that's just what it is.
We should probably go to some calls if you'd like to join the show. It's 833-99-WORTH, 833-99-WORTH.
Yeah, you can also send us an email at questions@moneymatters.com. We're starting off in California. Talk with Stephanie. Stephanie, you're with Allworth's Money Matters.
Hello, how are you?
Hi, Stephanie.
Trying to make a decision about long-term care insurance. Our assets seem to be right in that spot where it's not very clear if it's a good idea or not. Some help.
I hate these questions.
Well, it's like you're in California, right? It's like, should I buy? How do I get fire insurance on my home right now? It's like it's so expensive. So, how old are you, Stephanie?
So I'm 57. I'm married. My husband is 65. So the age gap was one consideration that I thought might weigh into it. The other factor is we don't have kids, so I know it's sometimes positioned as a way to protect assets for a guaranteed inheritance, but that's not a priority for us. We're trying to spend all our money.
Okay. And do you have any pension income, guaranteed income that comes in regardless of what's happening?
You know what? Social Security at some point at about $5,500 a month, and some small pensions that add another $1,500.
And then what do you have in retirement savings as far as IRAs, other mutual funds, bank accounts?
So I made a list here. I got preferred comp is at 1.3 million, IRA 401k 1.7 million, 70,000 in a Roth, about 100,000 mutual fund, and 500,000 cash. We kind of have that reserved for a retirement home that we're building in Japan.
Wow.
So you have approximately $3.7 million.
Yes.
And then what was the preferred? What was that?
Not
The
preferred.
1.3?
You meant deferred comp.
Yeah, deferred
Okay.
comp.
I'm like, this is.
Is it in a 457 or is it from a private company?
It's a private company,
Okay.
executive.
Okay,
plan.
an executive deferred comp. Okay. 3.7. And do you own a mortgage?
House is paid off, 600,000.
And when you build this home in Japan, will you sell your house in California?
No, we'll use it. You know, there's some resident restrictions over there, so.
And
we've
have
heard
you
it's
have you priced into some long-term care? Because it's primarily, I'm thinking, your concern primarily, I would guess, is that your husband, something happens to him, it's many years, and it drains your financial assets.
Yes.
Yeah.
So I was looking if there's a strategy, you know, does self-funding make sense, or is there a strategy with insuring one of us that might be a little more reasonable but provide some coverage? I know it's hard to tell who might get.
So I would look at
Have you shopped it at all?
No.
Okay.
So do you know if he qualifies for long-term care insurance?
He should qualify.
Okay.
Yeah, but I mean the window is getting.
Yeah, I get it.
smaller, right?
Right, I understand.
So I'd look into it. You can afford it. You can you could go either direction on this.
Yeah.
That's why I'm calling.
Here's what you want to look at, and we don't know the cost because, I mean, there is 10% of the number of long-term care insurance policies written today than there were 25 years ago.
Because so many people have exited the market. The insurance companies have exited the market because they lost so much money on this for two reasons. One is low interest rates, which is how they reserve. And the other is because of adverse risk selection, oftentimes having to do with massive employer plans.
So, and the reason there's not many people buying them today, a lot of companies have exited, and people go to shop and they're like, oh my gosh, how much you want to charge for this? I think I'll just take my own chances. So that's why I think it'd be important to look at some. I would look at two different types of policies. One is a standard policy that has they call it an elimination period. Is that what they call it?
Elimination period.
Think of it like a deductible on your car. You probably don't have a $250 deductible on your car, would be my guess. You have a higher deductible because you're like, I'm only going to wait until something really major. It's the same kind of concept. So considering that most long-term care needs are shorter, I think the concern is it's like a 10-year something, right? That's where it's a real problem. Most are shorter. So if you self-insure for the short and then say, then I want a policy that's going to pay a lifetime benefit should something happen, my husband gets Alzheimer's and lives 15 years with Alzheimer's.
So as an
Worst case
example, I go into a long-term care facility. The insurance doesn't kick in until day 366 or 730.
Depending on how long the waiting period is.
Which is the elimination or a waiting period, right? So I've self-insured myself for a specific period of time, and then after that, and then the insurance company kicks in. The premiums, it pushes the premiums down because the insurance company knows that most long-term care stays are less than 9 months.
Less than 9 months for men and less than 2 years for women.
Yes.
Okay.
So the second kind of policy you could look at, think of it like a single payment policy. And they're essentially life insurance policies, like a universal life. I don't know if whole life has it as well, I would imagine. Like a universal life insurance policy where you put in a chunk of money, let's call it, maybe it might be 150 grand, 200 grand, depending on how much benefit you want to buy. And it's in a life insurance policy. If you need long-term care, they essentially start taking your money first. And when you've exhausted your dollars, then the insurance kicks in. And if there's never any long-term care needed, then when someone passes away, there's a death benefit equal to the amount of the life insurance.
The downside to these is the fact that
we have to put the money up.
You put the money in, you're going to have that money tied up forever, right? Which isn't even I guess it's a downside. Maybe it's not in your situation.
Can you use IRA dollars to buy that?
I don't know.
I don't know either.
But they have plenty of money. You've got that money in the deferred comp that's actually going to be pushed out when your husband severs employment.
Is it a 457 plan or is it a deferred comp from an employer?
It's an executive deferred comp.
It's on a 10-year annuity payout.
See, so that's being paid out. So you can buy these things, and you have money in a brokerage account, you said as well. You can buy these things lump sum. What happens is my cash never grows in there. So if I put 150 grand in there,
20 years from now, it's worth 150.
It's worth 150. What the insurance company does is actually takes that money, the interest it earns, and uses it to fund their reserve for the long-term care. So essentially, you're doing exactly what these life insurance policies do, exactly what Scott just described with the elimination period. The difference is you know the outcome. The bad things is most of them are not indexed to inflation either. So those are the two places you could go. I would probably, in your situation, if I had a choice, I'd probably buy the life insurance policy if I bought one at all. But you can self-insure.
But until you know the price,
you can't make a decision.
Yeah.
But you're fine to self-insure. I mean, if your net worth was $2 million higher, I'd say, don't worry about it.
Yes, exactly.
Don't worry about it. If your net worth's $2 million lower, I'd say, don't buy it.
Because you can't afford it.
Because you can't afford
Yes.
it. But that's why I hate these calls, is because you're right.
We don't hate it's just, there's certain things in life that are really hard to.
Yes.
That's a really challenge to plan for financially, because the cost can be so great that it pretty much says, if you want to put your whole retirement plans on hold, we can get you insurance so that if you need long-term care, you don't have to worry about anything. But then you have no quality of life until that point. So you're essentially saying, I'm not going to have any quality of life the rest of my life.
Which is why I'd actually buy the life insurance one, because I know the outcome and when it comes. The downside is that they have no cost of living adjustment on it. But you've got plenty of money that you could tie it up, and you could reverse it at any time if you wanted to.
Would you do one of these policies on one of us, which is sort of like making the middle decision and sort of hedging our bets, but not over?
But some of them will cover both of you as well.
Yeah, I'd look at that. But I don't see the need for you having long-term care. You've got plenty of assets.
Right. Yeah. Okay. Good.
All right.
No, that really really helps. Thank you for taking the call.
Yeah, glad you called. Wish you well, Stephanie. And
appreciate you guys.
The only one I've talked to is saying they're building a vacation home in Japan. That sounds kind of cool.
All right. Yeah. Well, that's it's going to be pretty amazing. So.
Good. We'll come visit.
Okay, you're invited.
Thanks. Actually, I went to Japan a few years ago. I climbed Mount Fuji with my daughter and a couple friends. I loved Japan. It was we had a phenomenal experience. It was just a great experience. I'd like to go back to Japan sometime.
Okay.
But I have no intention of building a vacation home.
How high is Mount Fuji?
It's like 11 or 12,000.
And how long did it take you to climb it? It's not like rock climbing. You're hiking it, correct?
You're hiking, yeah. Well, we started at the base of the mountain, which most people don't.
Like the base of the mountain is like not at sea level.
2,000 or 2,000 feet or something.
Okay.
I don't know. It took us 8 or 10 hours or something.
Sounds miserable.
It was awesome. I had a great experience.
That absolutely sounds
fun,
miserable.
We're heading now talking with Patricia. Patricia, you're with Allworth's Money Matters.
Yes, hi. Good afternoon. Thanks for taking my call.
Hi.
I'm 62 years old. I have a rental property, and I have my primary residence, and I have an Airbnb. The rental property is really just breaking even over the last 10 years. By the time I pay taxes, insurance, property management fees, HOA, I've just really been breaking even over the last 6 years. I have my primary residence with a mortgage balance of $180,000.
What's it worth?
Then $1 million.
Okay.
What's the interest rate?
2.5%.
Wow. 30-year or 15-year?
15.
15-year.
And then I have the rental property. the interest on that is 7%, and I have a balance of 110,000, and the property is worth 330,000. So I kind of looked.
What'd you pay for it?
200,000.
How long have you owned it?
I paid 180,000.
Tell us about the Airbnb.
The Airbnb takes care of itself and then some. So the Airbnb I owe 54,000 on, but it's the interest on that is also 7%, and but it's profitable. I'm turning a profit on it. I'm making about $1,000 a month after all expenses.
And what's the value of the property?
That's worth about 200 and maybe 250, about 250,000.
And what did you pay for it?
165.
Okay, what's your question for us?
So I had the rental property. The tenants just left, and I'm trying to decide. I also have a vacant land that I purchased that I want to build another Airbnb on. So I'm trying to decide if I should sell the rental property since I'm really not making any money. It's just there building equity. But recently, the area that it's in has become like saturated with lots of new homes and rental properties. So I'm trying to decide if I should sell it and use the money, because when I did all the numbers, at the end I'm going to walk away with $296K if I get the asking price. And once I pay off the mortgage out of it, then I'll have $180,000 left, which I can use to pay off my existing mortgage.
But then you've got your silent partner, the tax man.
Yes, yes. So, and I have no write-off to my tax except for the rental property.
What?
My children are grown. I have no deductibles.
What's the rest of your financial situation look like?
Are you working, retired?
I'm working. I have no plans to retire. My job, I'm going to work as long as I can. And maybe not full-time, but I already estimated I need about $60,000 a year to live, and I make about somewhere between $150,000 and $180,000 a year.
And how much money do you have in savings, brokerage, IRAs, that sort of thing?
401k.
Yeah, all of that I have about $700,000.
Have you thought about doing a tax-free exchange with the rental with a better rental that you can Airbnb?
What is? I'm sorry. A tax exchange?
A tax-free exchange.
Yeah.
And what is that? I don't know what that is. Sorry.
Well, I always get confused between 1031
1031.
and 1031. Like, for whatever reason, I cannot.
1035 is in life insurance.
30-some years in this business, and I can never remember which one's 1031, which one's 1035. So it's called a 1031 tax-free exchange, and this enables you to sell that property, and as long as you buy something similar, like-kind property, within, I believe it's 6 months on both the front and the back, you can defer all of that gain, so you pay no capital gain tax.
But I will eventually have to pay the capital gains, right?
Yeah, but if you can defer the capital gains, you have more capital working for you. So if the strategy is just to sell the rental, and you net, let's call it $200,000, you're going to have to pay.
It's a no-brainer.
Almost 30% for capital gain tax.
Right.
Yeah, and so when you said this vacant land, I don't know if it would be there or not there, but I would explore the 1031.
Yeah, so the vacant land is actually out of the country.
Okay, well okay. So a 1031 into an Airbnb, brilliant.
The Airbnb is not out of the country, is that right?
Yes, the vacant. Oh, yes, they are. They both are two different countries. They're both out of the country.
Wait. Where's the Airbnb?
One is in Jamaica, and the other one is the vacant land is in Costa Rica.
All right, well, go fish. I have no idea how it would work there.
But if I paid it,
you can't. I don't think you can do it. You can't do an exchange. Out of the U.S. But I can't. Could I? If I sold it and used the money to pay off my existing mortgage of the house I live in, I would still have to pay capital gains.
Oh yes,
of course.
Yes.
But if I bought another like property with it, I wouldn't.
In the U.S., if you follow the rules and use an intermediary to do the 1031 exchange, they're not that complicated. Okay. I've done it personally, and I've advised many clients over the years.
Yeah, but the problem is that Yeah, you'd have to buy an Airbnb in the U.S. The rental
Right.
property is in the U.S.
Okay, but let's say I'm going to do that, then I wouldn't end up paying off the mortgage because I'm just thinking I could be debt free.
You can't pay off the mortgage. You've got that. You probably $50,000, $60,000 in capital gain tax, maybe more.
Oh.
Maybe not that. What
I
would you
was
pay?
thinking, like, take the money out of my
$150,000
savings
and the
account.
depreciation, $40,000 to $50,000 in capital gain tax between feds and.
Yeah, because my interest rate is so low on my present mortgage. I just thought, like, why don't I take the money out
Yeah,
of
I
the
wouldn't.
bank?
I would not pay off that primary
yeah,
mortgage.
you don't pay off the primary.
Oh, okay, all right.
All right.
Yes, okay. Thank you very much.
All right.
Appreciate
Okay,
it.
appreciate it.
Yeah.
I was getting confused there. Thank you for tracking.
I could not imagine having a rental property outside of the United States. Having one in the same town, it could be challenging enough.
Yeah, and she wants an Airbnb outside the U.S. And by the way, the Airbnb is, it's popular for many investments. And when my family and I travel, we stay in VRBOs, which are
Same things.
similar. Airbnb, someone could be living in the house.
Okay, but when you're traveling with your family, you're not looking for a room. You're renting the whole house.
Correct.
And sometimes you see the same property listed on both. If I've done the same, and I'll look for VRBO and Airbnb and rent wherever's cheaper. Because oftentimes they're listed on both.
That's right. And oftentimes they're actually listed on, you and I owned a weekly rental for years and years, and it would list on all of the things. But oftentimes, if it's a condo, let's say in a Marriott, it will be listed on the Marriott's website as well.
Yeah.
What's
your point?
My point being is that what you should worry about in these particular Airbnbs is the local legislation around them.
Oh, yeah.
So in South Lake Tahoe, which we are very familiar, both Scott and I are,
because it's in our backyard.
Yes, they have. They put a moratorium on new Airbnbs or VRBOs,
and we took away the permits for many existing ones.
But the Airbnbs and the VRBOs, they have lots and lots of risk in them. You have friends that you read these articles about people, and then you read another article 3 days later where people are like dying with these things.
I had an acquaintance that didn't have was renting his house out, didn't have a permit, wasn't allowed to do it. He finally got busted on it.
Did he?
And he was telling me about all the money he's making on it in this place in Southern California. And I'm like, well, you're not allowed to do. Like, I'm thinking, how long do you think that's going to go on for?
Of course, you're doing well. It's illegal.
That's what I thought. There's lots of different things we could talk about that are illegal where you might make some money.
Yes, of course you're doing well. I robbed these banks. Listen, it worked perfect until the 13th one. Hey, every once in a while, we like to follow up with calls that we've had in the past. First of all, just out of personal curiosity.
Yeah.
Like, where did this go? Was our advice taken? If it was taken, was it taken in whole or part? And we like to call these things house calls for whatever reason.
Yeah.
But it sounds like a fuller brush man. For those people that don't know what a fuller brush man is, it's a guy that used to come to your house.
It's one of those jobs I thought I'd like to do that for a day, just to try what it's like being a fuller brush man. It's a different era, but
So a fuller brush man is a man that would come to your house and sell brushes.
and that sounds quite sexist. It could be a fuller brush female.
Okay, but very similar to how Amazon works today. But we like to follow up with these calls, and today we're going to talk to Brian.
That's right. We spoke to Brian last February, and he was in an interesting situation where you've got a parent is trying to do something to make everything even, and Brian's life was quite... Anyway, listen to the clip, and then we'll have a conversation with Brian. Have you owned a home in the past?
No, I've just rented just to keep my housing costs as low as possible so I can put away. Eventually I got to a good emergency savings and then eventually good 401k. And by then houses were rather expensive, and I'm not married, no kids. And then recently I like to travel. So I'm out of the country could be 3 to 6 months a year.
That changes things.
Yeah.
And so when you move out of the country, do you keep your rental or do you give it up?
Last time I kept it for about 3 months, but this time I'm thinking it's time to move on anyway, and I'm going to get rid of it.
And you're gainfully employed?
Yes, I can work remote, and I'm able to kind of do
People
both.
listen, I don't get this lifestyle.
Oh, no. Where did I go wrong?
I know.
Yeah, it's not bad.
So you sit down on an island and you actually have like a Photoshop bookshelf behind you when there's really a beach?
Brian, you said you're 37?
38.
38.
And what's your income ballpark from your employment?
150,000.
And what do you have saved?
Everything.
Everything 430,000, 300 of which is retirement tax advantage, and the rest is money market and index funds.
I hear that you don't want to buy a home.
Yeah, why would you want to buy a home?
Yeah, I don't. So it's like, do I convince my dad that, this is my strategy? I certainly appreciate the funds, and my thought would be to invest most of the money into VTI and maybe
how
take those
old is
small
your dad?
chunks to fund travel. He's 74, and they're pretty well set for their retirement.
They're not
I'm
doing this for
taking
estate
away.
tax purposes then.
They want to even out.
No.
They've gifted their other two kids.
They want to give to. And what do you think of getting a rental home?
I think it's kind of like I work in real estate as an accountant, and it's kind of like chefs in restaurants. They don't cook all day and then go home and make elaborate meals. And I think when I get home, I'm just tired of looking at real estate, and I prefer, my strategy is to focus on my time on my career, travel, and then passive investing versus most people I talk to don't like being a landlord.
Yeah, I don't like being a landlord.
I could live with it.
And then the house, at my index funds, I don't have to put
I get it.
furniture in them. I
You know, it's funny.
to pay
So I'm going to tell you.
property tax.
2 days ago, I'm on a walk with my wife, and I said to her, actually, I'm on a walk with my wife, and I got a text from a property manager. Can you please call me? And I, is the house on fire? Right. And I text back, and the washer was broken, and he thought it's time to get a new washer and dryer.
Your mutual fund never calls you.
I said to my wife, and it's been a good investment but I said to my wife, I really love equities. And I said, here's the conversation we had.
You had this conversation with your wife on a walk.
She barely tolerated it, but yes. I was
How
trying
romantic.
No, well, and I said, that one of the benefits about getting a little older, you're still quite young. You didn't remember the pain of the financial crisis. One of the benefits of getting older, you've lived through all these cycles, and you see that companies, the values of companies continue to grow. And when you look over the long-term return, you mentioned VTI, the total stock market index, you look at the long-term return of stocks, it's about 6 to 7 percentage points above that of the rate of inflation. It's hard to replicate that in any other asset class.
It is.
Real estate, rental, anything.
It is.
And it never calls you and says the washer's
And there's no
broken.
leverage in there, so the downside risk isn't as great.
Correct.
So just tell your,
I would have a conversation. I'd have a conversation with your dad and say, "Look, my lifestyle's a little unconventional,
but I'm happy. I'm assuming you're happy.
I would love to take these dollars and invest them for the long term for my own financial security, just like my brother's financial, but in a slightly different way."
And I'd take it one step further. I would take a clip of this show and say, "Hey, I talked to these guys that I listened to their podcast, and this is what they said." And quite frankly, your dad may know. And by the way, that's the only way we're gaining listeners is one at a time. Brian, of these places you've traveled and worked, what was your favorite?
Oh, recently it would probably be Malaga, Spain, although I almost don't want people to find out about it, but that was really...
Is that
really
the southern tip?
Yeah, that's in the southern tip. You can take a ferry to Africa just about, but But yeah, great weather. Has the old town. Has the beach.
I've actually been to Malaga.
All right, second favor.
Second favorite.
Well, where do you plan on going next?
Lisbon was quite good.
I like
Lisbon's
Lisbon.
a great
I've never
city.
been to Lisbon.
That's
I
getting
liked
a little overcrowded, but it was quite good.
Yeah, it's got quite
And
the
next,
American.
Next stop's Italy.
So, Brian, you're with us now, right?
Yes,
And are you overseas as we speak?
I am.
And out of curiosity, are you comfortable sharing where you're at?
Sure. I'm in northern Italy in Liguria in the Italian Riviera, in a small Italian seaside village.
Yeah.
That does sound pretty nice.
I was in Puglia a couple of weeks ago.
Of course you were.
We were yeah, but I don't live
With the Truly.
I don't live like Brian does. So anyway,
You're like a week and a half.
I know.
Once a year.
Yeah, exactly. So I assume you're still gainfully employed?
I am. Yeah. So I've been here for a month, and it's working out well. And I took your advice.
Yeah, so how'd it go?
Yeah, it went good. I simply just shared the podcast with both of my parents, and Dad came around pretty quick saying, you're right. This sounds like it's the right thing for you to do, and it's an investment style that works for you, and plus you got your travel lifestyle. And I think he asked, that was the first comment, and the second comment was something about, are you going to get the tattoo on your foot? Because I think you guys said something about your son.
Okay.
Has a send it tattoo on it.
Still waiting for my send it, but I have not sent it yet.
So this is a way that we could gain listeners to the podcast, Scott, is we could have...
So did they give you the cash?
I got $50,000 right before I left, which they had already sort of had in the works. I didn't really know. And then a bit more may come in January, so they can put it in a different tax year. And so I took the 50, and I immediately put 15 in a total stock market index fund, and then I'm sitting on 35 left over from that because I kind of took. I had a lot of changes going on. I was moving out of the apartment. The apartment's gone now. I have no costs back home. And I know when you talk to guests and they have it's not exactly the same, but when someone has an inheritance, you tell them don't do anything straight away while you're, going through
it's a little different
change or a life change. And so
this is a little different situation. We don't. I mean,
a little different, yeah. But so I'm sitting on now. I guess the follow-up question would be: I'm sitting on $100,000 in cash in a high-yield money market, and I probably just need to pull the trigger.
You know what you need to do. You don't need us to answer the question. You're just nervous
Brian,
about doing it.
It's always hard to invest because if the markets are up, you're like, man, it's on a tear right now. I'm going to wait until there's a pullback. And when the markets are going down, you're like, I don't want to invest right now. Things are going down. I'm going to wait until things are a little lower.
But you know what to do. You're just nervous about doing it. Just do it.
Okay.
Over the long term, it's not going to make. Look,
yeah.
Who knows a year from now?
Or 2 years or 3 years. But what we do know is you're how old?
37, 6?
Right?
38.
38? Okay.
Yeah, you've got a long time. So just keep whatever liquid cash you need in the high yield, but that should not look. You laid out in that call we had a few months ago. You laid out your thesis, and now you've actually veered from it.
That's right. Human nature,
right? You told us what you should do, and then when you actually came time to do it, you didn't do it.
I parked in it, but yeah, now I got to go.
Yeah, go do it.
It's not because it's not even the whole amount. It's the majority is coming next year in the future.
Yeah. So you know what to do. I have a couple personal questions for you. What after Italy? Where? Do you know?
I have no plan. I just kind of let things evolve or develop and ask people where to go. I wrote down Puglia when you said it a second ago.
Yeah.
And, I do have for a couple weeks.
And when you travel like this, do you stay in an Airbnb or do you rent a room or?
Yeah, I'm in an Airbnb most of the time, and I actually made a little deal on this one. I rented it for a week, and then I met the landlord, and then once I tested the internet, and I had to do a lot of work this week, so I wanted to stay put for a while, and then I offered cash for an extra week, and it was a pretty good price on the cash price.
Anyway, hey, thank you for doing this house call to follow up. Appreciate it, and continue enjoying. This guy's living life.
Yeah, and I think there's two. I appreciate the call, Brian. There's a couple takeaways from this. One is if you're planning on leaving money to your kids, like the world's different today.
It is, and sometimes better from a warm hand than a cold heart.
Okay, Pat.
I had a client actually say that to me, and then gifted 3 of his children money.
Well, Pat, it is getting. I think we're getting close to being done with the program.
Yeah, we are. But I'd like to ask the listeners 2 things. One, if you'd be so kind as to rate us, and maybe even write a review. That would
if it's a good one.
Well, you can't. We're not allowed to say that.
Or if it's a bad one.
Okay.
Good or bad, we love them all.
If you could rate us, please. Our marketing keeps telling us that we've got over 100,000 subscribers, and that pretty soon we're going to hit a tipping point, and something magical is going to happen in my life because of this.
After 30 years, we're going to be overnight successes.
Right. And then the second thing, if you'd be so kind as to share this with a friend and see if they enjoy it. And we're trying to build a listenership here, one listener at a time.
Yeah, and follow us if you don't follow us. That way it's dropped into your feed somehow on a.
That's right.
And as we're signing off here, Pat, your son got married last weekend, right?
Yes.
Everything went well?
Yes, so glad it's over. It was a beautiful wedding. No fireworks. Everyone seemed to have gotten along. And
nothing weird happened? The bride didn't trip or anything?
No.
That's probably
good.
It was
pretty nice. It was nice. But thank you for asking.
Congratulations.
Thanks for asking.
Hey, we'll see you next week. This has been Scott Hansen and Pat McLean, Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.